speaker for the day, Alla Gil, has been the global head of strategic risk advisory at Goldman Sachs, Citigroup, and Nomura. Who better to learn from, right? So I would urge you all to stay on and kind of participate in this conversation. And I'll bring Pankaj over to kind of lay the context for this. And after that, one last thing. This is all by demand only. But as I was preparing, I told you my whole Gemini trick. I also asked it to write a one-liner about each of these sessions. And then the first round of one-liners seemed very global, not very LAQSA for India, therefore India-centric. So then I asked you to do another set of one-liners for each of these sessions. Time permitting, we can go through all of those as well. But what I realized was all the one-liners that AI created for this audience is exactly like this audience. They're enthusiastic, witty, sharp, and quite nerdy as well. So I congratulate you all for already being understood by AI. I don't know what that means for us. But on that note, where is the great Pankaj? There you go. Over to you, sir.
Hi, Alla.
Hi, Pankaj.
Yeah, thank you. Thank you for joining. It's a great pleasure to have you, and people across the Indian institutions are waiting to listen to you. So thanks for joining. And so let me introduce everyone. Alla Gil has been he's the CEO of Straterix, which provides unique solution in the stress testing, scenario analysis, and all the risk management things. And she has been the ex-global head of Goldman Sachs, Citibank, Nomura in the domain of strategic advisory. So she's a global expert whom you are going to listen. And in the current scenario of volatility, trade war, and all those things. So it's a great pleasure to have you, Alla. And please introduce yourself and say hello to the audience. And please go ahead.
Thank you so much. You can hear me, right?
Yes, we can hear you.
Yeah. Thank you. Great to be here and talk to you about modern way of using machine learning and artificial intelligence and all the richness of data to have a little bit better, more advanced focus on risk management, especially longer term horizon, early warning signals, etc. But also, obviously, how to handle the current extreme uncertainty that we are facing in the market literally for the past 5 years, and obviously this year even worse than before. So let me share my screen.
Yes, sure.
Excellent.
Yeah, we are able to see you. Please go ahead. Thank you.
Wonderful.
Thank you.
Wonderful. Thank you. So first, I wanted to go a little bit further back in the history and discuss how the risk management has been transformed and risk measures have evolved over past 30 years. In the 90s, value at risk was a very novel integration of market credit and operational risks, and incorporating tail risk, right? So economic capital, by definition, was amount of capital that's supposed to cover losses above and beyond expected loss for reasonable and foreseeable amount of losses. So that obviously included at least 99th percentile, but the largest financial organizations would use 99.9 percentile to cover, to have economic capital to cover these losses. But guess what? During financial crisis that happened already, like 17 years ago, it turned out that economic capital didn't help people. Why? Because it had very low credit risk between 2004 and 2007. Credit risk was extremely low. Risk in general in the market was low, and when people calibrated their economic capital, they ended up having the lowest amount of capital right before the global financial crisis, when they supposed to have a huge capital cushion. So that's why right after global financial crisis, people switched to the scenarios. And scenarios were supposed to overcome exactly the problems with economic capital. So first, it was supposed to be longer term horizon through the cycle. It's supposed to find the reliance on macroeconomic variables. So in addition to just market credit and operational risk, you need to look at a bigger macroeconomic picture. And on top of that, it's supposed to cover some important historical scenarios, but also include hypothetical scenarios. So obviously, a huge progress comparing to economic capital. Why? Because when COVID hit, and obviously COVID wasn't part of any scenario that people ran in 2019. Nevertheless, when COVID hit in 2020, banks and financial institutions were very well capitalized. They had enough liquidity. They were much better prepared. So the point is, it's important to be prepared to all of the scenarios, and how you name your shop didn't matter. But in 2023, this scenario CCAR failed to protect the industry from regional bank crisis. Why? Because it was limited number of scenarios, and all of these scenarios were focused on a major crisis when rates go sharply down, and there was no scenario that would include rates going sharply up. So that's why there was a call for looking at a lot more scenarios. But how many scenarios economists can prepare for you? At most, it's half a dozen scenarios. And when you look at them bottom up, it is very difficult to kind of cover all possible combinations of the events. And this is where the full range scenario analysis comes in. So the point is to complement the regular bottom-up scenario analysis that is still very important, to complement it with the top-down full range scenario analysis, where you look look over all possible combination of shock events and their ripple effects, but you do not project every single loan, every single deposit, or every single insurance policy and QSAVE on the asset side. You know, like you don't go to that level. You look at the segments. You look at the uniform segments, and that gives you enough precision to cover the tail risk, to identify which scenarios can be really bad for you. Which means that the point of full range scenario analysis is not prediction, what will happen. That's a totally futile exercise. And it's not precision, because when people talk about long-term potential consequences and precision, it's a false precision. The important point is to get the themes, what can go wrong, and to cover all possible scenarios that lead to the tail. And then you kind of can be prepared for the upcoming potential turbulence. So let me show you a sample process and framework, right? So if this is the distribution of the current exposures, right, of current portfolio, right? And the way people often do it now, they look at the bell-shaped part of the distribution separately from the tail. But this is exactly where inefficiencies are coming from, because every time you have increased volatility in the bell-shaped part of the distribution, the probability of arrival of extreme events goes up. So it's very important to look at this distribution consistently, and then by focusing on reducing or eliminating the tail risk, you can simultaneously achieve lower risk and higher return. Because in long-term strategic asset allocation, in balance sheet positioning, quite frequently tails wag the center, the expected value. If you don't consistently understand your tail, you don't know what your expected return is. But when you diagnose what is driving your tail and you eliminate it, then you can get a much more optimal distribution. Now, why we think that it is very important to do it through the scenarios and not just through constructing semi-parametric distribution with tail risk? Because you need to know how your distribution in year one is connected to your distribution in year two. And only scenarios when the distributions are created empirically from the scenarios, you can see this type of dependency. You can clearly see that something that has very low probability but very high severity in year three, what are the early warning signals of that? And then, based on early warning signals, by tracing back the scenarios, you can develop contingency plans and action points. So I was working with all major international banks during global financial crisis, and they all told me that at the end of 2007, before global financial crisis, but at the end of 2007, they all could see where the situation is going. But by the time they ran their contingency plans through investment committee, operating committee, management committee, risk committee, etc., it was already September of 08, Lehman default, and it was too late. So the whole point of scenario analysis is to develop these contingency plans in advance. So when the triggers for the action point are realized, they're defined way ahead of the time, and when the triggers start realizing, you don't need to run it through the committees, it's pre-approved, you just start executing the contingency plan. And this is a case study for the current situation. So in this case study, we analyze three major lending segments, charge-offs in three major lending segments. These lending segments are commercial and industrial lending, consumer lending, this is orange line, and residential mortgages, which is green line. So why I selected these three segments for the example? Because they are very relevant for banks, but they also relevant for insurance companies that sometimes participate directly in the loans. It's also relevant for any kind of structured credit, for private credit, etc. So it's kind of representing some kind of private credit that is available now very widely to everyone. Now, what we can see here, and by the way, the data for this charge-offs is taken from Federal Reserve Economic Database, so it's across all major banks in the US. That's publicly available data. Now, when the charge-offs were projected on all generated scenarios, on the full range of scenarios, we identified what is driving each one of the segments to be in their worst case charge-offs in 99th percentile, not for the sum of all charge-offs, but each one of them is in its own 99th percentile. What is driving that? And we have identified specifically three different scenarios. I gave them the names based on the yield curve shapes on this scenario. So what you can see, yield curve, it's like all tenors on the yield curve, right? So these are 3 months, 1 year, 3 year, 5 year, 7 year, etc. So all, obviously all US tenors for yield curve. And what you can see, the first scenario definitely looks like pretty sharp, pretty deep recession that usually corresponds with rates going sharply down, and somewhere in Q4, and then inflation, right? The rates go sharply up. The second situation, even though you can see it's a 99th percentile, but still 99th percentile for CNI, but it's not as severe because here the charge-offs are like around 16-17%, while here they're reaching 30% or something. And also it's lower for consumer lending, and approximately the same for residential mortgages. But the yield curve shape is very different. It is not as sharp, mild recession, but it happens much sooner, and then it's stagflation for a long time, and then inflation follows. And the third scenario that was identified that drives all three segments in 99th percentile is actually, like a fairly mild recession with inflation that is pretty high, but the yield curve remains inverted. So that's the third scenario. Now, let me emphasize that the way to generate the full range scenarios can be different. So we have developed one way of generating full range scenarios, and I am happy to share how exactly we've done it. It could be other ways of generating full range scenarios, but it cannot be standard Monte Carlo. It has to incorporate shock events and their potential consequences. Shock events can be historical or hypothetical, and the key point is you don't necessarily give the names to these shock events. So we don't care, it could be tariffs shock or some other shock, some other geopolitical shock. It pretty much, the important thing is to be ready for outcome, is to be ready that if my charge-offs are going above certain level, what part of my balance sheet is driving that, what kind of yield curves are driving that, and what macroeconomic factors are driving that. And here on this page, you can see macroeconomic factors on all three scenarios. And you can see they're quite different. So the first scenario, recession, then inflation, you can see, for example, the triple B spread goes sharply up after the first year. So that's consequences of recession. In the second one with stagflation, it's sharp increase in triple B credit spread, and then like for a while it's kind of low, and then it goes up again. And then and then the third one, like again, you can see very different behavior. And the same, you can see very different behavior for equity markets, CPI, GDP, and unemployment. And by the way, unemployment more or less very similar to triple B credit spreads and to CPI on behavior, how things are happening. Now, what is so interesting here? That economists usually come up with very smooth scenarios. They do not come up with scenarios with kinks, with sharp raisings and droppings, and combination of shock events. Usually each scenario is a smooth story. It can be very severely adverse story, but it's still a fairly smooth story. Now, what you get through exhaustive reverse scenario analysis, you get the story that gives you the combination of events, for example, yield curves that have some hump around 1 year tenor, right? No stress scenario built bottom up would come up with a hump around a certain tenor. Nevertheless, it can be one of the worst scenarios for specific performance of specific financial institution. For example, it could be a sign that embedded optionality between prepayment option on the asset side and callability option on the liability side, that this embedded optionality is misaligned. Now, what is so important about these scenarios, which can be a very probable scenario by itself, but cause the worst case outcome for your balance sheet, that usually it's very easy to mitigate these scenarios. It's very easy to mitigate risk because the scenarios that are built bottom up quite often are the doomsday scenario. Meteorite hitting the earth, what can I do about it? Nothing, right? But identifying your own specific scenarios through this reverse scenario analysis gives you some very actionable items how to deal with that. For example, as a continuation of exactly the same case study, because we have GDP outcomes and CPI outcomes on absolutely all the scenarios, we can figure out the probability of recession and the probability of inflation. Now, we define the probability of recession as 3 quarters in a row of negative GDP. And here are these probabilities, right, in year 1, 2, and 3. Oops. So you can see the quarters are in the first row, and the probabilities are here. So you can see that it's probably not as severe as economists are predicting now, but it's pretty close. And by the way, I think in the past few days, even Moody's reduced their probability of recession in this year down from 50% to probably 45 or something. So you can see these probabilities extracted from the scenarios. You can see the probability of inflation that we defined as CPI index exceeding 4%. So again, you can redefine it. You can say negative GDP over 2 quarters in a row, and then the probability will go up. You can define inflation as exceeding 5% or 6%, and then the probability would go down. So you can define, you can ask a question, but the full range scenario analysis provides the answer. Now,
Ella, can we summarize this in next 5 to 7 minutes so that we could have some questions also?
Yes, absolutely.
Thank you.
So what you can see down here is another answer that you can get from the full range scenario analysis, which is the contribution. Which sector contributes how much, and you can see if this is the total default losses with different percentiles, right, over next 3-year horizon, what different sectors have contributed to that. You can also apply the full range scenario analysis to private assets. Here you can see private credit and few private equity investments, and you can see if the expected value across all scenarios is green. You can see when the average of tail scenarios, 99th percentile scenarios, if this average is closer to all scenarios, that is a good diversifier of your portfolio. If the average of the tail scenarios what people call contingent expected tail, is closer to the minimum, that is not a diversifier. So it's very easy to make these diagnostics. It's very easy to look at projected cash flows and mark to market, because again, on each scenario at each point in time, you have all the cash flows and all risk neutral discount factors. So you have full consistency and flexibility on how cash flows are reinvested. This is a similar exercise just done to private assets. So I will not focus on that too much. Pankaj, you will share the slides and people can look at it.
Sure, sure.
So the key point is that you can dig in on the scenarios that were specifically adverse and see like these zigzags, like these lightning signs, they represent the shock events. So the blue ones are historical, the orange ones are hypothetical, and the yellow markers here for the quarters, right? So it's all in time, 12 quarters. Yellow marked means that this variable at that point becomes early warning signal for the overall outcome. This is similar exercise on the liability side for the deposits, and the same exercise can be done for insurance on behavioral patterns. So why we kind of separate deposits here? Because it's not necessarily investment strategy, it's behavioral patterns of your depositors that also can be projected on the scenarios. And as a result, you can actually project, like Camel's rating is something that Federal Reserve, how Federal Reserve ranks financial institutions. It stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market. So it's aggregated ratio, and this aggregated ratio can be projected forward on the scenarios. So two banks that were assumed to be totally comparable, peer banks, in Q0 project very different behavior. So it gives research analysts an idea how they can look at their universe of banks. And finally, I just wanted to show how exactly we generate these full range scenarios that incorporate shock events. What we do, we look at every historical time series. I mean, it's not we, obviously, it's an algorithm, right? It's machine learning algorithms that separate from historical time series, separate stable markets and the shocks, 99 percentile outliers defined as the shocks. Then the shocks are cut off and stable markets are used to calibrate diffusion part, so the standard Monte Carlo simulation based on historical covariances and drifts without outliers. And then outliers that were cut off are used to generate the shock impact, right? So every shock is a Poisson style event with probability and severity that is calibrated to historical shock, because what the standard Monte Carlo would do, it would smooth everything out, and you will never get this type of outcome by projecting it forward. But if you use jump diffusion, you actually get simulated tails very, very similar to actual historical tails. What also Poisson events do, when with a given probability they can happen on a specific scenario, and severity impact moves equity markets down, credit spreads up, etc., what you get naturally dynamic correlations. We all know that correlations between PDs and LGDs are very different in normal markets and in stable markets. The copula correlations between default events are very different in normal markets and in stressful markets. And the correlation between interest rates and credit spreads and equity markets also is very different. And you obtain these dynamic correlations naturally on full range generated scenarios. That enables you, this is one of the back tests, right? Back in 2021, when interest rates were historically lowest and went negative in certain geographies, and obviously it was totally unprecedented for rates to go from 0 to 5%. This type of using the data prior to 2021 produce the outcomes that really happened in 2022 with realistic probability, small probability, but still the probability that risk community has to be prepared for. So let me stop here, and there are a couple more case studies that will be distributed. You can take a look at it. I also have a number of publications in GARP, Risk Intelligence, Global Association of Risk Professionals. So they have more detailed explanations and more examples.
So thank you, Ella, for the wonderful session. And I think it has been a very, very important topic that we have covered. And so first question from, not a question, just for just a point from my side, that tail risk is quite important, and we should have the infrastructure, we should have the process to detect that tail risk in the form of scenarios analysis and reverse testing and advanced thing that we have mentioned. But at the same time, my view is that there definitely exists some kind of unpredictability in the sense that no matter how many scenarios we produce or computer generates, there can be some more scenarios that we could not imagine, and that can happen actually in the real world scenarios. So I think for those kind of unpredictable scenarios, I think we should focus on the fragility to those unknown factors, rather than trying to calculate the probability of that on the impact space. And that's how I think it can be very, very important tool for tail risk management. So what's your view? I would like to hear.
So Pankaj, I think first it's extremely important to have the full distribution consistently, tail and no tail, because you need to be prepared for tomorrow and you need to be prepared for a year from now, right? So that's why the consistent distribution that can go on a daily basis and it's still consistent over long-term horizon for insurance companies, we can run 10 years or more. That is very critical. Second, I totally agree with you that it is not the probability of scenario itself, is the probability of outcome. Because what people quite often underestimate, that very, very normal, kind of very likely scenarios, but just unusual combination of market drivers can drive their worst case outcomes. So that's why the distribution, the probabilities should come from your liquidity needs, your asset liability management, your CECL IFRS 9 and capital, not from scenarios itself. I totally agree with you. It's impossible to predict what will happen. You try to look at multiple combinations. And by the way, for the audience, I have an article that says what banks can learn from airline flight simulation, because it doesn't matter why your engines went down, you have to learn how to land on water. So it's not about exactly what's in the scenario. It's what can happen to you and how can you mitigate it.
Thank you for the wonderful explanation. So we have one audience question. My friend Chris, he is from US, and he will ask you, he has worked in banks, so many banks, so he will be asking one of the questions to you.
Thank you very much, Ms. Gill. So I wanted to ask, you're doing some really, looks very complex, and obviously it's much further than I think what some of us do, which might be a kind of a Monte Carlo simulation or a fixed set of scenarios. How do you decide, or when do you decide that you've tested it enough, or you have a good enough range? Do you have certain kind of parameters for each asset class, or do you customize for each situation? How do you know, or how do you feel reach that point where you're happy with that you've done enough testing?
Well, this is a great question. This is data-driven analysis, and with data-driven analysis, it's pretty much, I've been doing it for many years across multiple geographies and multiple financial institutions in many market environments. So the point is that the true answer is in backtesting. And I just gave you one example of backtesting, but we do tremendous amount of examples, and we prove that between 1,000 scenarios to get initial idea to 10,000 scenarios to kind of fine-tune and look more precisely at hedges, for example, is enough. And I have quite a number of backtesting examples here that I didn't have chance to go through, like UK pension scheme, when Bank of England said it was extreme example. You probably all know that pension industry in UK was almost destroyed and required a lot of infusion from the government, while our scenario analysis, backtesting, all of that is backtesting, shows that it was 87th percentile. Our backtesting shows that SVB was fully preventable. Regional bank crisis was fully preventable because full range scenario analysis included inflation. And I have a lot of other examples like that.
Thank you, Ella. So we have one more question, and is from someone from Goldman Sachs only. So please ask.
Hi, Ella. That was a very nice talk. So in past, I worked on similar problem, and I had a qualitative question on that. So we had quantitative ways to design scenarios even before, and one of the pushback which came was, quantitatively it looks fine, but we don't qualitatively think that it's a likely scenario. Of course, 2-3 years later, it will become a real scenario. Do you see there has been a change in mindset that people rely more on quantitative scenarios now? Because I at least remember 10 years ago, we try to do the similar thing, but always there was a qualitative pushback that this is a very unlikely scenario, and we won't prepare for this risk.
Yeah, no, I totally agree with you that there is a very major change in people's mentality that, like they do need more scenarios and they do need help from data science, right? Not just economists, because it was always like economists come up with scenarios and, like automatically generated scenarios are not intuitive enough. So they obviously have to be totally explainable. So in my experience, even before global financial crisis, when I talk to the CFO of a major financial institution and I tell him, you must look at the scenarios that real estate prices go down 50%. And we are in the middle of the biggest real estate boom, right, in 2005. And he says, oh, you quants with your kind of, like nightmare scenarios, that's not possible. But when you walk him through the steps of this scenario, right, you're telling him, well, do you agree real estate is a bubble? Yes, everyone agrees real estate is a bubble. Do you agree that prices can go down just 10%? Yes, everybody agrees. Prices can go down 10%, but not 50%. Okay. But when prices go down 10%, do you understand that your loan to value ratio is 95%? And it's average across the industry. With loan to value ratio at 95% means that 10% down means 5% negative equity. Do you understand that more people will default when they have negative equity in their house? Yes, everyone agrees. And then, okay, when people default, there are foreclosures, the prices go down another 5%, etc., etc. You walk him through this scenario, and suddenly he is like, oh my God, real estate prices can go down 50%. So with quantitative scenario, with data science and machine learning, it must be explainable. Otherwise, people will never act on that. And I think now people are kind of getting more into this mentality.
Thank you, Ella. Thank you, Ella, for the wonderful explanation. So I hope the audience enjoyed and they are clapping for you. It was a pleasure to have you. So see you again soon, and I'll do the needful.
Thank you very much.
Thank you. Yeah, so thank you for listening. Actually, I know everyone must be tired, and I'm tired too. And I feel that with the tail risk, there is a soldier risk, and my soldiers are paining now. So, soldier risk? People talk about tail risk, but what is soldier risk? Anyone has heard about soldier risk? Soldier risk is basically when you try to hedge your tail risk and your costs start becoming very expensive, then that becomes a soldier risk, and that can be a very dangerous thing. So anyway, so I'm just going to give you 10-15 minutes summary because what exactly the issue is. And the issue is very serious because since morning I have been listening to the great people, everyone talking about standard deviation, beta, volatility, drawdowns, something. But problem is really serious. And problem is not serious, it's superficial. It's a problem with the statistics itself that is used even for factors, strategies, risk management, and all those things. Why? There's a famous paradox, Simpson's paradox, and even Abu Dhabi Investment Authority is working on that. No, it's fine. I will 10-15 minutes. So why the problem is serious that you calculate beta, correlation, standard deviation, whatsoever. Take a sample, calculate beta, correlation, standard deviation, whatever you want to calculate. Take another sample, calculate the same thing, combine both the samples, and you may get negative of what you got in both these samples. And on that beta correlation, you are trying to frame your strategies. Say, for example, you are doing pairs kind of strategies. And on the basis of beta, you are trying to take position long or short or whatsoever. Now, if you are not able to calculate your beta only properly, it can lead to a huge loss. And it has happened. But people globally are worried about it. It's a very serious problem with the statistics, and it's still a unsolved paradox in itself. So how do you determine those statistical parameters on what basis you are taking your trading positions and all those things? It's a very, very serious question. You can, if you want to have, you can just go through ADIA lab paper and you can see how serious this issue is. The point is, what I'm trying to make, you know, fooled by randomness by Taleb. I think a deeper issue is fooled by your own mind. Our mind only fools us more, and we have to be very careful about it while doing a statistics especially. The reason is, see, I just show you. There is a problem in mathematics also, there is a problem of undecidability. If you have heard of Gödel and Turing, there is a problem at the foundation of mathematics, undecidable statements. You cannot decide whether this statement is true or false. It's a very serious problem. And similar undecidability or randomness exists in statistics as well. But our mind, human mind, loves certainty. It hates randomness or uncertainty. When we talk about these standard deviation, correlation, and all those things, we have to understand where they work and where they don't work. There are certain areas, certain range of data, types of data where these are valid. Mathematically or statistically, they are valid. But in certain scenarios, which is called fourth quadrant, they are not valid. Technically, they are not valid. But what the blunder is, that psychologically we tend to apply all these things in the fourth quadrant always, where this is mathematically not valid. There exactly the tail risk occurs. So you can see the volatility is a very misleading matrix of risk. Why? Do you think that the things which have low volatility, very stable, very less drawdown, is really less risky? Not always. But if you look at the practitioners, many use these things to show their risk. But these do not capture the tail side of risk, which is very dangerous, where these metrics do not hold true. And that's the real problem is, that how do you determine those kind of risk where you can blow up? People think that they are outperforming, but many of them are statistically not. You can see when you do regression kind of analysis, you can see even the R square, which is a very famous thing, even that has its own distribution. Even a standard deviation also has its own distribution. Distribution of correlation, see, this is used for diversification. See the distribution of correlation. When you, anywhere when you write that this correlation is 0.2, 0.4, how misleading it can be. You have to be careful. And even for stress testing, what Ella was talking, there's a concept of higher order stress testing. Have you heard about higher order stress testing? It's an advanced concept of stress testing that tries to hedge your model risk. Because if your model is wrong and you are trying to create scenarios and everything on the basis of that model, what if your model is itself wrong? And that can be disastrous. It has happened. So for that, higher order stress testing is applied to hedge those model risks. So why even you can see the behavior of max drawdown. Problem is that statistics and risk management is that we often try to calculate all those figures based on the past data, what we are observing. But the real risk comes from observable aspects of the things in the future. And how you are going to hedge and deal with those risks, very few people talk about it. And I think it's quite psychological. Our mind have been trained to use all those tools unless we fail. And then God becomes our ultimate risk manager. फिर देखा जाएगा जो होगा वो. And this is the problem. This is a very deep problem. And so you have to be convex to those unknown scenarios. Unknown randomness is there, unpredictability is there, and there is some fundamental limitations with mathematics also, with the statistics also, and with mind also. How you are going to deal with those. So for that, you have to understand that, as well, I was talking to my co-founder Rishi, and we have a group in LAQSA. I hope all people join someday. So we keep on engaging in some interesting discussions that if you try to eliminate all the risks, you are creating one big risk. Like you have law of conservation of energy in physics, science. Similarly, there is a law of risk also. And you have to, while you manage your tail risk, you have to understand which risks are essential. Without those risks, you cannot generate return. Those tail risk or risk has two components. One component that is essential scientifically to generate return. And there is another component that you should not be exposed to, that can blow you up. So that differentiation is very, very important. That is not generally understood. And one who understands this is also able to manage cost of hedging. Because if you will start hedging everything, then you will blow up and you will have soldier risk, like soldiers are paying or what I was talking about. So you're starting, and most of the tail funds get exposed to soldier risk. They hedge and they bleed. Because they are not able to figure out which risks to hedge and which risks to take. And that's very, very important. And you have to be convex to those unknown scenarios, unknown, unpredictable things. And that's how you're going to survive. Because even Taleb and Dodi, they have been my collaborators. I'm also writing one paper with them right now. So, because when we talk about performance analysis and all those things, many of us talk about alpha and all those things. But we don't talk about much about the risk part. And that is often underestimated. Randomness, things can happen in a more random way than we expect. But at the same time, randomness, as I quote, this is my quote, randomness is not randomly random, rather deterministically random. So point is what I'm trying to make. I'm just going to summarize it now because time is up. So I hope you're getting what I'm trying to convey to you. Tail risk is quite important, and you have to understand which component of risk you have to take, which you have not to take. How do you decide cheapness? I recall some of the people we were trying to register at the last moment for the event, and then they were saying that they were options traders. I'm just taking humorously, I don't want to name. So they were options traders, and they told me yesterday that I want to register I told them that why you have seen the message. They told that they had seen the message 1 month ago, but registering now. So I told that was the discounted registration price. Why are you registering now then? If you're an option trader, you should be able to figure out what is the cheapness of options. So that time it was cheap, but you didn't buy. Now you are requesting me that I want to come to the conference. So if you are really an options trader, you should be able to understand even the real life that what is cheapness. It's not just options only, it's in life also. What is cheapness, what is value? So a lot of things to talk about. Even tail scenarios. People often talk about 5 standard deviation, 6 standard deviation. And I had a discussion with Nassim Taleb on this, that even tail, we talk about first order tails, that fat tail, thin tail, all those things. But there are higher order tails also. Speed of tail, slow tail, high tail. Are you getting what I'm trying to do? Slow tail, like moving car is slow or fast. Slow tail, fast tail, accelerating tail. There are so many advanced concepts. So it's a universe in itself. And you have to, if you try to hedge your tail risk, you have to understand those complications. Simply note that it is tail risk. Because the higher, fast tail has a different dynamics. Slow tail has a different dynamics. Accelerating tail has different dynamics. So a lot of things are there. It's a detailed discussion, so we'll have to take some workshop or maybe something like that. But I'm trying to close this session now.